This video is about the 5 major financial traps designed to quietly drain your savings after age 60, and the exact steps you can take right now to shield your hard-earned retirement income from them. Most people think retirement is about making smart investments. The truth is, once you pass 60, the game changes completely. You're no longer trying to get rich. You're trying to protect what you've spent a lifetime building. And that's where many good people get blindsided. Hidden inside our tax system, healthcare system, and insurance rules are financial tripwires that can cost retirees thousands or even hundreds of thousands of dollars with a single mistake. Today, we're exposing the 5 most dangerous traps targeting older Americans, from Medicare lock-ins and Social Security tax surprises to insurance clawbacks and home equity pitfalls. More importantly, I'll show you the practical steps you can take right now to keep your money where it belongs, in your pocket. The first trap may be one of the most dangerous because it looks completely harmless when you first encounter it. At age 65, millions of Americans are flooded with advertisements promoting Medicare Advantage plans. The commercials are everywhere. They promise $0 premiums, extra dental benefits, vision coverage, hearing benefits, grocery cards, transportation assistance, and a long list of perks that make traditional Medicare seem outdated. And honestly, when you're healthy, it can look like a fantastic deal. That's exactly why so many people sign up. But here's what many retirees don't discover until years later. Private insurance companies are businesses. Their job is not simply to provide health care. Their job is also to control costs. That means many plans operate with restricted provider networks, prior authorization requirements, and approval systems that determine what care gets covered and when. Now imagine this. You're 65, active, healthy, and rarely see a doctor. A Medicare Advantage plan works perfectly. Then 10 years pass. You develop a serious heart condition. Maybe you receive a cancer diagnosis. Maybe you need a specialist at a major medical center in another state. Suddenly, the network that never bothered you before becomes a problem. So you decide to switch back to traditional Medicare. And that's when many retirees discover the trap. It's called the Medigap trap. Most people don't realize that when they first enroll in Medicare Part B, they receive a special 6-month window to purchase a Medigap policy with guaranteed acceptance. No health questions, no underwriting, no medical review. Once that window closes, the rules change dramatically in most states. Insurance companies can legally examine your health history. They can charge higher premiums, and in many cases, they can decline your application entirely. Think about how backwards that is. When you're healthy, you don't feel like you need supplemental protection. When you're sick and finally need it, it may no longer be available. That's why retirees can become effectively trapped inside a private Medicare Advantage network precisely when they need the broadest access to specialists and advanced care. So what's the defense? First, if your budget allows, strongly consider pairing traditional Medicare with Medigap Plan G during your initial enrollment period. That 6-month window is one of the most valuable opportunities you'll ever receive in retirement. Second, learn your state's rules. Some states offer additional protections that many people never hear about. In places like Connecticut, Massachusetts, and New York, retirees enjoy far stronger guaranteed issue rights than most Americans. And if you live in states such as California, Oregon, or Maryland, special provisions known as the birthday rule may allow you to switch plans without answering health questions during certain periods. Most importantly, don't assume a denial is automatic. Different insurance companies use different underwriting standards. An independent broker can often help compare multiple carriers and uncover options that aren't obvious. Now let's move to a trap that doesn't come from an insurance company. This one comes directly from the tax code, and it has been quietly ambushing retirees for decades. It's called the Social Security Tax Torpedo. Many retirees assume their Social Security benefits are tax-free. After all, they paid into the system for 40 or 50 years. Why would those benefits be taxed again? The answer lies in a little-known IRS calculation called provisional income. The formula combines your adjusted gross income, certain tax-exempt interest, and half of your Social Security benefits. If the total crosses specific thresholds, a portion of your Social Security suddenly becomes taxable. Here's the part that makes this so frustrating. The thresholds were established back in 1983. They were never adjusted for inflation, not once. Meanwhile, year after year, retirees receive COLA increases. The government increases benefits because prices are rising. But those same benefit increases can push retirees into tax territory that was never intended to capture today's middle class. As a result, retirees who never considered themselves wealthy suddenly find themselves paying taxes on benefits they assumed were protected, and the numbers can get ugly fast. Imagine a retiree who needs an extra $1,000 from a traditional IRA to pay for an unexpected expense. Most people assume they'll simply pay their normal tax rate. But under the tax torpedo rules, that additional withdrawal can drag more Social Security income into the taxable column. In one example, a retiree in a 22% tax bracket withdraws $1,000. The expected tax bill would be around $220. Instead, the interaction with Social Security taxation pushes the total tax cost to roughly $407. That's an effective tax rate of more than 40% on a relatively modest withdrawal. And it doesn't always stop there. Cross the wrong income threshold, and you may trigger another hidden penalty called IRMAA. This is where a relatively small increase in income can cause Medicare premiums to jump significantly. Many retirees don't even realize they've crossed the line until the higher premium notice arrives. So how do you defend yourself? One of the most powerful strategies involves using what many planners call the gap years. These are the years between retirement and the age when required minimum distributions begin. During this period, many retirees temporarily find themselves in lower tax brackets. That creates an opportunity. By performing gradual Roth conversions, you can move money from traditional retirement accounts into a Roth IRA while controlling the tax impact. Yes, you'll pay taxes on the conversion today, but in exchange, you're building a future source of tax-free income that won't inflate your provisional income and won't expose more of your Social Security benefits to taxation. The goal isn't to eliminate taxes entirely. The goal is to avoid being blindsided by rules you never knew existed. And as you're about to see, the next trap proves that some of the most expensive retirement mistakes don't happen because people make reckless decisions. They happen because they follow what seems like perfectly reasonable advice. The next trap starts with something that sounds responsible. In fact, many hardworking Americans fall into it because they're trying to do the right thing. Let's say you've worked past 65. You're still employed. You already have health insurance through your employer. Because of that coverage, you decide to delay Medicare Part B. That's perfectly legal in many situations. Then retirement finally arrives, or maybe you're laid off unexpectedly. Your employer offers COBRA coverage, allowing you to keep your existing health insurance for up to 18 months. Most people assume they're protected. After all, they're still paying for health coverage. They're still insured. Everything seems fine, but that's where the illusion begins. Under Medicare rules, COBRA is not active employer coverage. The moment you stop actively working, a clock starts ticking. It's called the special enrollment period, and it lasts only 8 months. The critical mistake is that many retirees think this deadline starts when COBRA ends. It doesn't. The clock starts when active employment ends. That's a massive difference. Imagine someone retires at 66. They elect COBRA and assume they'll sign up for Medicare when COBRA expires 18 months later. By then, they've already missed the enrollment window. Now they're facing something that can follow them for the rest of their lives: a lifetime Part B penalty. For every full 12-month period you delay Medicare Part B when you should have enrolled, your premium permanently increases. Not for a year, not for 5 years, forever. And because Medicare premiums generally rise over time, the dollar amount of that penalty rises too. But as bad as that sounds, there is an even more frightening version of this trap. It's called implied coverage. Most retirees have never heard the term, yet it has financially devastated people. Here's how it works. Once you're eligible for Medicare, many COBRA plans begin treating Medicare as the primary payer, even if you never enrolled. In other words, the insurance company calculates claims as though Medicare should have paid first. And if Medicare wasn't there because you never signed up, the insurer may refuse to cover the amount Medicare would have paid. Think about that for a moment. You paid your premiums. You believed you were covered. Then a major medical event happens, a surgery, a hospitalization, cancer treatment, and afterward, you're told the coverage wasn't functioning the way you thought. One documented case involved a retiree who was hit with a $150,000 clawback demand after her insurer determined she should have been enrolled in Medicare Part B. The company sought reimbursement for claims they argued Medicare should have paid. Whether you're 65, 68, or 70, that's the kind of financial shock that can destroy years of careful retirement planning. So what's the defense? Treat Medicare enrollment deadlines as seriously as tax deadlines. If you're no longer actively working and you're eligible for Medicare, do not wait for COBRA to expire. Enroll in Part B during your special enrollment period. And if you have a younger spouse who still needs coverage, remember that your healthcare decision doesn't have to be identical. They may remain on COBRA while you move directly into Medicare. That simple adjustment can help protect the entire household. Now let's talk about a trap that often begins with a free steak dinner. A trap wrapped in promises of safety, certainty, and guaranteed income. The fourth trap is the annuity rolling surrender clock. If you've ever attended a retirement seminar at a restaurant, you've probably heard the pitch. Guaranteed income, protected principal, no downside risk, sleep well at night. Those promises sound attractive, especially after decades of market volatility. But what many retirees don't realize is that some annuities come with complicated fee structures and lengthy surrender schedules designed to lock up your money. The salesperson may earn a substantial commission when the contract is sold, and those commissions are often recovered through restrictions placed on your access to your own savings. The most dangerous version is something called the rolling surrender clock. Most people assume the lockup period begins when the contract is opened. That would be logical. Unfortunately, some contracts work differently. Every new contribution can start an entirely new surrender schedule. Imagine opening a contract today with a 10-year surrender period. 5 years later, you add more money. Many retirees assume those funds become available when the original contract matures. Instead, the new deposit may begin its own 10-year countdown. The result? Money added in year 5 may remain restricted until year 15. That's not what most people expect when they hear the word liquid. And if an emergency forces you to withdraw funds early, the damage can compound quickly. You may face a surrender charge from the insurance company. You may owe ordinary income taxes on the gains. And depending on your age, additional IRS penalties may apply. Suddenly, accessing your own money becomes surprisingly expensive. That's why every retiree should understand exactly what they own. Ask for 3 numbers: your cost basis, your cash surrender value, and your taxable gain. Those 3 figures reveal far more than a glossy brochure ever will. If you already own an annuity, don't panic. Many contracts allow annual penalty-free withdrawals. And in some situations, a 1035 exchange can move funds into a more efficient contract without triggering immediate taxes. Most importantly, work with professionals who are legally obligated to act in your best interest. The difference between a salesperson and a fiduciary can be worth thousands of dollars over the course of retirement. And now we arrive at the final trap, one of the most emotionally charged financial products ever marketed to older Americans: the reverse mortgage trap. Reverse mortgages are often presented as a simple solution. You have substantial home equity. You need cash. The lender offers a way to access that equity without making monthly mortgage payments. On the surface, it sounds almost perfect. Stay in your home, receive money, no monthly mortgage bill. But beneath that appealing message is a reality many families don't fully understand. The first issue is upfront costs. Reverse mortgages often carry significant fees that are added directly to the loan balance. That means your equity begins shrinking from day one. The second issue is something called negative amortization. With a traditional mortgage, every payment gradually reduces the loan balance. With many reverse mortgages, the opposite happens. Interest accumulates. Insurance charges accumulate. The loan balance grows. And because interest is calculated on a growing balance, the process accelerates over time. Meanwhile, the homeowner's equity steadily declines. The longer the loan remains active, the larger the gap becomes. But perhaps the most dangerous misconception is the belief that a reverse mortgage guarantees you'll never lose your home. That's simply not true. Borrowers must still pay property taxes. They must maintain homeowners insurance, and they must keep the property in acceptable condition. Failing to meet those obligations can place the loan in default, and default can ultimately lead to foreclosure. Then there's the issue many couples never see coming, the non-borrowing spouse risk. Imagine a husband qualifies for a reverse mortgage because he's over 62. His wife is younger and doesn't qualify as a co-borrower. Years later, the husband passes away or permanently enters long-term care. The loan may become due. Suddenly, the surviving spouse faces an overwhelming legal and financial challenge while coping with a family crisis. That's why reverse mortgages should never be approached as a quick fix. Before signing anything, understand every fee, understand every obligation. And if one spouse is under 62, seek professional legal guidance before moving forward. Retirement isn't won by making spectacular financial moves. It's won by avoiding devastating mistakes. That's the common thread connecting every trap we've discussed today. Medicare Advantage lock-ins, the Social Security Tax Torpedo, COBRA enrollment mistakes, annuity surrender traps, reverse mortgage risks. None of these problems are caused by a stock market crash. Most happen quietly. One overlooked form, one misunderstood rule, one signature on a contract, one deadline that seemed unimportant. The good news is that awareness is powerful. When you understand the rules, you can avoid becoming another cautionary tale. Retirement is not about doubling your money. It's about protecting your income, preserving your independence, and keeping control of the assets you've spent decades building. If you found this helpful, make sure to like the video, share it with someone who is approaching retirement, and subscribe for more practical guidance designed to help ordinary Americans protect their savings and avoid costly retirement mistakes. And I'd love to hear from you in the comments. Which of these 5 traps surprised you the most?